Everyone thinks they see the crash coming. Financial pundits on television warn about market bubbles, economists publish papers about unsustainable debt levels, and your neighbour at the barbecue swears the whole system is about to collapse. But here's the brutal truth. When the real crash hits, it doesn't look like what anyone expected. It doesn't announce itself with sirens and flashing lights. It creeps in wearing the mask of prosperity, disguised as innovation, celebrated as progress. And by the time you realize what's happening, your savings are gone, your future is mortgaged, and the very people who promise safety have vanished with your wealth. Right now, in 2025, we are living through the exact same patterns that destroyed fortunes in 1929. The same psychological traps, the same financial engineering, the same mass delusion that this time is different, but it's not different. It never is. And the crash that's building today will make 1929 look like a gentle correction. The scariest part? Almost no one sees it coming. Not the experts, not the institutions, not the government officials who swear they've learned from history. They're all staring at the wrong indicators, fighting the last war while the real battle unfolds in plain sight. But if you understand what really caused 1929, and if you can recognize those same forces at work today, you might be one of the few who not only survives what's coming, but profits from the wreckage others leave behind. Let me take you back to 1928 when America was drunk on its own success. The economy was booming, technology was revolutionizing daily life, and everyone from shoeshine boys to bank presidents was getting rich in the stock market. Sound familiar? It should, because we're living through the same intoxicating fantasy right now. In the late 1920s, Americans believed they had discovered the secret to permanent prosperity. The stock market had been climbing for years. New industries like radio and automobiles were creating millionaires overnight, and credit was flowing like water. People who had never owned stocks before were borrowing money to buy shares, convinced that prices would keep rising forever. Margin buying, where investors put down just 10% of a stock's value and borrowed the rest, became as common as morning coffee. Banks, drunk on easy profits, lent money to anyone with a pulse and a dream of getting rich quick. Does this sound insane? It should. But here's what made it seem rational at the time. For years, it actually worked. Stock prices kept climbing, margin buyers kept getting richer, and anyone who warned about unsustainable debt was dismissed as a pessimist who didn't understand the new economy. Innovation was changing everything, they said. Old rules didn't apply anymore. The business cycle had been conquered by human ingenuity and modern finance. Today, we tell ourselves the exact same story. We've replaced radio and automobiles with artificial intelligence and electric vehicles. We've swapped margin buying for options trading and leveraged exchange-traded funds. We've traded newspaper stock tips for social media influencers promising easy wealth through cryptocurrency and meme stocks. But underneath the modern packaging, it's the same dangerous game. Ordinary people borrowing money they don't have to buy assets they don't understand, convinced that prices will rise forever. The Federal Reserve, which barely existed during the 1920s boom, was supposed to be our insurance policy against another 1929. Central bankers promised they had learned from the past that they could manage the economy with scientific precision, preventing both crashes and excessive speculation. But instead of preventing bubbles, they've become the primary source of them. Since 2008, the Fed has pumped trillions of dollars into the financial system, keeping interest rates artificially low and making it cheaper than ever to borrow and speculate. They call it quantitative easing and stimulus. But it's really just a more sophisticated version of the same credit expansion that fueled the 1920s bubble. Here's where it gets terrifying. The numbers today are bigger than anything 1929 could have imagined. In the late 1920s, total American debt was roughly equal to the size of the entire economy. Today, it's more than 3 times larger. Corporate debt has exploded to levels that would have shocked even the most reckless speculators of the Jazz Age. Consumer debt, from credit cards to student loans to mortgages, has reached heights that make the 1920s look conservative. And government debt, it's grown so massive that the interest payments alone consume more than the entire federal budget of the 1920s. But raw numbers don't tell the whole story. What makes today even more dangerous than 1929 is how the debt is structured and who holds it. In the 1920s, most speculation was concentrated among relatively wealthy investors who could afford to lose money. Today, pension funds, insurance companies, and retirement accounts are all tied to the same inflated markets. When this bubble bursts, it won't just wipe out speculators on Wall Street, it will destroy the savings of teachers, nurses, firefighters, and retirees across the country. The psychological patterns are identical too. In 1929, ordinary Americans became convinced that buying stocks was the path to easy wealth. They quit their jobs to trade full-time, mortgaged their homes to buy more shares, and ignored every warning sign because the money kept flowing. Today we see the same mania with different assets. People are refinancing their houses to buy Bitcoin, maxing out credit cards to trade options, and treating investment apps like slot machines. The technology has changed, but human nature hasn't. And just like in 1929, the experts are reassuring everyone that this time is different. Back then, economists pointed to new technologies, increased productivity, and better business management as reasons why stock prices could keep rising indefinitely. Today, they point to artificial intelligence, globalization, and central bank intervention. The specifics change, but the arrogance remains constant. The belief that we've conquered the economic cycle through superior knowledge and modern tools. But here's what the experts missed in 1929, and what they're missing again today. Bubbles don't burst because of external shocks or unexpected events. They burst because they become mathematically impossible to sustain. When enough people are borrowing money to buy overpriced assets, the system reaches a point where any interruption in the flow of new buyers causes a cascade of forced selling. It's not a question of if this happens, but when. The warning signs are everywhere, but they're hidden behind a wall of complexity that makes them hard to see. In 1929, you could walk down Wall Street and see the speculation with your own eyes. Crowds of people gathered around ticker tape machines, newspapers full of get-rich-quick stories, shoeshine boys giving stock tips. Today, the speculation is digital, algorithmic, and abstract. High-frequency trading programs execute millions of transactions per second, creating an illusion of liquidity that can vanish in milliseconds. Derivatives markets, which barely existed in 1929, have grown to dwarf the underlying assets they're supposed to track. The global financial system has become so interconnected that a crisis anywhere can trigger collapses everywhere. What makes this particularly dangerous is the role of passive investing. Millions of Americans now automatically funnel their paychecks into index funds, believing they're making safe, diversified investments. But when everyone owns the same assets through the same funds, diversification becomes an illusion. When the selling starts, these funds will be forced to dump stocks regardless of their value, amplifying the crash in ways that 1929 never experienced. The parallels extend beyond finance into psychology and culture. In the 1920s, Americans developed an almost religious faith in the power of debt and speculation to create wealth from nothing. Easy credit wasn't seen as dangerous borrowing, but as financial innovation that democratized opportunity. Today, we've gone even further, turning debt into a lifestyle and speculation into entertainment. Credit cards are marketed as tools of empowerment, student loans are sold as investments in human capital, and trading apps gamify speculation with the same psychological tricks used in casinos. Meanwhile, the real economy, the one that actually produces goods and services, has been hollowed out by decades of financialization. In the 1920s, America still made most of what it consumed. Today, we import manufactured goods and export financial services, creating an economy that looks prosperous on paper but lacks the productive foundation to support its debt load. When the financial bubble bursts, there won't be enough real economic activity to cushion the fall. The most chilling similarity between 1929 and today is how confident everyone feels about their ability to see trouble coming. In 1929, investors believed they were smarter than previous generations, that they had access to better information and more sophisticated tools. They trusted economists who assured them that the Federal Reserve could prevent any serious downturn, and they dismissed warnings from pessimists who didn't understand the new economy. Today we make the exact same mistake, believing that our computers and models and central bankers can protect us from the same forces that have destroyed wealth throughout history. But the crash of 1929 didn't happen because people were stupid or ignorant. It happened because they were human. They fell victim to the same greed, fear, and herd mentality that drives every bubble and every crash. They believed that this time was different, that old rules didn't apply, that they could get rich without risk. And when reality finally reasserted itself, the devastation was swift and merciless. The setup for today's crash is even more dangerous because the stakes are higher, the debt is larger, and the interconnections are deeper. When this bubble bursts, it won't just affect stock speculators or real estate investors. It will ripple through pension funds, insurance policies, government budgets, and international trade relationships. The crash of 1929 led to a decade of economic depression. The crash won't begin with sirens or headlines screaming about market collapse. It will start quietly, in the shadows of the financial system, with the kind of technical problems that most people never hear about. A pension fund will miss a payment here, a regional bank will freeze withdrawals there, a cryptocurrency exchange will suddenly go offline for maintenance. The financial media will explain these away as isolated incidents, temporary glitches in an otherwise healthy system. But what they won't tell you is that these aren't separate problems. They're symptoms of the same disease that killed the economy in 1929. The first domino to fall will likely real estate. Office B commercial buildings across America sit half empty as remote work has permanently changed how businesses operate. Shopping malls that once anchored suburban communities now stand as monuments to a retail economy that no longer exists. The loans that funded these properties were bundled and sold to investors, just like the mortgage securities that triggered 2008, but this time the problem is bigger and the solutions are fewer. When these loans start defaulting, the damage won't stay contained to real estate. It will spread through the banking system, insurance companies, and pension funds that bought pieces of the toxic debt. Banks today are more fragile than they were in 1929, despite all the regulations passed after the last crisis. They've loaded their balance sheets with government bonds, believing these are the safest possible investments. But when interest rates rise, as they inevitably must when inflation takes hold, the value of those bonds collapses. We got a preview of this in 2023 when Silicon Valley Bank and Credit Suisse imploded within days of each other. The only reason more banks didn't fall was that central banks stepped in with emergency funding, essentially printing money to paper over the cracks. But each rescue makes the system more unstable, not less. The derivatives market represents the most dangerous parallel to 1929 that almost no one understands. In the 1920s, investors used simple margin loans to buy stocks with borrowed money. Today, the leverage is hidden inside complex financial instruments that even the people trading them don't fully comprehend. Interest rate swaps, credit default swaps, and currency derivatives create a web of interconnected bets that spans the entire global financial system. The total notional value of these instruments is estimated at over $600 trillion, more than 7 times the size of the entire world economy. When counterparties start failing to meet their obligations, the cascade of defaults will make 1929 look like a minor accounting error. But the real killer won't be any single financial instrument or market sector. It will be the loss of confidence itself. In 1929, the crash accelerated when ordinary Americans realized that the wealth they thought they owned was largely imaginary. Bank deposits vanished, stock certificates became worthless paper, and the economic prosperity that had seemed so solid revealed itself as a mirage built on borrowed money and false promises. Today, the illusion is even more complete because so much of our wealth exists only as digital entries in computer systems. When people lose faith in those systems, the collapse will happen at the speed of light, rather than the speed of telegraph wires. The warning signs are flashing red, but they're written in a language that most people can't read. Corporate earnings are being propped up by stock buybacks funded with borrowed money rather than genuine business growth. The yield curve, which measures the difference between short and long-term interest rates, has inverted in a pattern that has preceded every recession for the past 60 years. Consumer confidence surveys show people feeling optimistic about their personal finances while expressing deep pessimism about the overall economy, the same contradiction that appeared just before previous crashes. Housing markets across the country are showing the same speculative fever that marked the peak in 2006. Buyers are waiving inspections, bidding sight unseen, and stretching their finances to the breaking point to get into properties they can't really afford. The difference is that this time, it's not just subprime borrowers taking crazy risks. Doctors, lawyers, and tech workers are treating real estate like a casino, convinced that prices can only go up. When the music stops, the foreclosure crisis will make 2008 look contained. The psychological setup is perfect for a crash that catches everyone off guard. Americans have been conditioned to believe that the Federal Reserve can prevent any serious economic downturn by cutting interest rates and printing money. This faith in central banking has created a moral hazard, where investors take increasingly dangerous risks, knowing they'll be bailed out if things go wrong. But the Fed has already used up most of its ammunition fighting the last crisis. Interest rates are still near historic lows, the money supply has already been inflated to dangerous levels, and the government's debt burden means that traditional fiscal stimulus could trigger a currency crisis. International factors make today's situation even more precarious than 1929. Back then, America was largely self-sufficient and could absorb economic shocks without depending on foreign creditors or supply chains. Today, we're the world's largest debtor nation, dependent on continuous inflows of foreign capital to fund our government and lifestyle. China holds over $1 trillion in US Treasury bonds and could trigger a dollar crisis simply by refusing to buy more. Supply chains that seemed efficient in good times have proven fragile when disrupted, creating shortages and inflation that compound economic instability. The social and political consequences of the coming crash will be far more severe than anything experienced in the 1930s. During the Great Depression, Americans still had strong family networks, local communities, and cultural institutions that helped them survive economic hardship. Today, social bonds have been weakened by decades of mobility, technology, and individualism. When the financial system collapses, millions of people will find themselves isolated and unprepared for the kind of mutual aid that helped previous generations weather economic storms. Political institutions that provided stability during past crises have been hollowed out by partisanship and corruption. The New Deal programs that helped America recover from 1929 required a level of social trust and governmental competence that seems impossible to imagine today. Instead of pulling together to solve problems, political leaders will likely blame each other while the crisis deepens. This institutional failure will turn what should be a painful but temporary economic adjustment into a prolonged period of social and political chaos. The velocity of modern markets means that when the crash begins, it will unfold much faster than 1929. In the 1920s, it took weeks for news to spread and months for financial institutions to fail. Today, algorithmic trading can trigger massive sell-offs in minutes, social media can spread panic in real time, and electronic banking can cause runs on deposits faster than regulators can respond. The same technology that was supposed to make markets more efficient and stable will instead amplify the crash beyond anything history has ever recorded. What makes this particularly cruel is that the people who will suffer most are those who followed all the conventional advice. They maxed out their 401k contributions, bought diversified index funds, and trusted that steady investing would secure their retirement. But when every asset class collapses simultaneously, diversification becomes meaningless. The teachers, nurses, and firefighters who dutifully saved for decades will watch their nest eggs evaporate, while the financial insiders who created the crisis walk away with golden parachutes. The crash is already beginning, but it's happening so gradually and in such complex ways that most people don't recognize it. Inflation is destroying purchasing power while wages stagnate, creating the same squeeze on living standards that preceded 1929. Corporate profits are being maintained through financial engineering rather than productive growth, just like in the late 1920s. Asset prices have become completely disconnected from underlying economic fundamentals, sustained only by momentum and the greater fool theory that someone else will pay even higher prices. But unlike 1929, when the crash led to reforms that addressed some of the underlying problems, today's crash will likely be followed by even more dangerous policies. Politicians and central bankers will respond to the crisis by doing more of what caused it in the first place, printing money, bailing out failed institutions, and creating new bubbles to replace the ones that just burst. This will set up an even bigger crash down the road in a cycle that can only end with the complete destruction of the current monetary system. The parallels to 1929 are so exact that it's almost as if we're following a script written by history itself. But this time, the stakes are higher, the weapons are more powerful, and the fallout will be global rather than confined to one country. The crash that's coming won't just reset stock prices or real estate values, it will reshape the entire economic and political order, destroying institutions that took generations to build and creating opportunities for those wise enough to position themselves correctly. The tragedy is that every warning sign flashing today was visible in the months before October 1929, but people had trained themselves not to see them. Irving Fisher, one of America's most respected economists, declared just weeks before the crash that stock prices had reached a permanently high plateau. Sound familiar? Today's experts make the same confident predictions, using the same flawed logic that destroyed fortunes 95 years ago. In 1929, the smartest people in the room were absolutely convinced they had solved the puzzle of perpetual prosperity. They pointed to new technologies, increased productivity, and sophisticated financial instruments as proof that old economic laws no longer applied. They had radio, automobiles, and assembly lines. We have artificial intelligence, electric vehicles, and algorithmic trading. The tools change, but the arrogance remains identical. What nobody understood in 1929 was that bubbles don't burst because of outside forces. They collapse under their own mathematical impossibility. When too many people are borrowing money to buy overpriced assets, the system reaches a tipping point where any interruption in the flow of new buyers triggers an avalanche of forced selling. It's not economics, it's physics. Today's bubble has grown so large that it defies comprehension. The derivatives market alone represents over $600 trillion in notional value, nearly 8 times the entire global economy. These aren't investments in productive assets. They're bets on bets on bets. creating a house of cards so tall that a single gust of wind could topple the entire structure. In 1929, the speculation was visible on every street corner. Today, it's hidden inside algorithms and computer servers, but the danger is exponentially greater. The Federal Reserve, which was supposed to prevent another 1929, has instead created conditions for something far worse. By keeping interest rates artificially low for over a decade and flooding the system with printed money, they've encouraged exactly the kind of reckless speculation that destroyed the economy in 1929. But this time, the central bank is out of ammunition. Interest rates are already near zero, the money supply has been inflated beyond recognition, and the government's debt burden means traditional stimulus could trigger a currency collapse. Corporate America has become addicted to cheap money in ways that make the 1920s look conservative. Companies that should have failed years ago have been kept alive by easy credit, creating an army of zombie corporations that consume resources without producing real value. When interest rates rise, as they must when inflation forces the Fed's hand, these companies will collapse en masse, taking their employees, suppliers, and creditors down with them. The housing market provides the clearest parallel to 1929's speculative mania. Buyers are bidding on properties they've never seen, waiving inspections, and stretching their finances beyond any reasonable limit. Investment firms are buying entire neighborhoods with borrowed money, treating homes like stock certificates rather than places where families live. The same mentality that drove stock speculation in the 1920s has migrated to real estate, but with even more devastating potential consequences. What makes today's situation more dangerous than 1929 is how the speculation has infected every corner of the economy. In the 1920s, most Americans still lived on farms or worked in factories, providing a stable foundation beneath the financial froth. Today, the entire economy has been financialized. Teachers' pensions are tied to private equity funds, small businesses depend on complex derivatives for basic operations, and even municipal governments have become speculators in exotic financial instruments. The psychological patterns are identical to those that preceded 1929, but amplified by technology and social media. Instead of crowding around ticker tape machines, people stare at trading apps that turn speculation into a video game. Instead of getting stock tips from shoeshine boys, they follow influencers who promise easy wealth through cryptocurrency and meme stocks. The delivery mechanism has changed, but the underlying delusion remains the same. The belief that you can get rich without working, without risk, without understanding what you're buying. Banks today are more fragile than their 1929 counterparts, despite decades of supposed reform. They've loaded their balance sheets with government bonds, convinced these represent safe investments. But when interest rates rise to combat inflation, the value of those bonds collapses. We saw a preview in 2023 when Silicon Valley Bank imploded overnight, followed by Credit Suisse and several regional banks. Only massive central bank intervention prevented a complete meltdown, but each rescue makes the system more unstable, not less. The international dimension adds layers of complexity that didn't exist in 1929. Back then, economic crises were largely national affairs. Today, global financial markets are so interconnected that a banking crisis in Switzerland can trigger margin calls in New York within minutes. Currency swaps, cross-border derivatives, and international debt obligations have created a web of dependencies that will amplify any crash into a worldwide catastrophe. China's role as America's largest foreign creditor creates vulnerabilities that if government holds no historical parallel. The Chinese over $1 trillion in US Treasury bonds and could trigger a dollar crisis simply by refusing to buy more, or worse, by starting to sell what they already own. The same globalization that seemed to spread prosperity has also spread systemic risk to every corner of the planet. The velocity of modern markets means that when the crash begins, it will unfold at digital speed rather than the telegraph pace of 1929. High-frequency trading algorithms can execute millions of transactions per second, creating flash crashes that happen too fast for human intervention. Social media can spread panic instantly, turning isolated incidents into global contagions before regulators even understand what's happening. But the real killer won't be any single trigger event. It will be the loss of confidence itself. In 1929, Americans discovered that much of their wealth was imaginary, existing only as numbers in ledgers and promises from institutions. Today, the illusion is even more complete because so much wealth exists only as digital entries in computer systems. When people lose faith in those systems, the collapse will happen at the speed of light. The warning signs are everywhere, but they're written in a technical language that most people can't understand. The yield curve has inverted, corporate debt has reached historic levels, and asset prices have become completely disconnected from economic fundamentals. Consumer sentiment surveys show the same contradiction that appeared before previous crashes. People feeling good about their personal situation while expressing deep pessimism about the overall economy. Inflation, the silent killer that destroyed German savings in the 1920s and Argentine pensions in the 2000s, has returned with a vengeance. Central banks insist it's transitory, just as their predecessors claimed in every previous inflationary spiral. But inflation is never transitory when it's caused by monetary expansion, rather than temporary supply shocks. The same money printing that was supposed to prevent deflation has instead created the conditions for hyperinflation. What makes this particularly cruel is that the people who will suffer most are those who played by all the rules. They saved diligently, invested conservatively, and trusted the experts who promised that diversified portfolios would protect them from major losses. But when every asset class collapses simultaneously, diversification becomes meaningless. The teachers, firefighters, and nurses who sacrificed for decades to build retirement savings will watch it all vanish while Wall Street insiders cash out just before the crash. The social fabric that held America together during the 1930s has been shredded by decades of mobility, individualism, and technological isolation. When the financial system collapses, millions of people will find themselves without the family networks, local communities, and civic institutions that helped previous generations survive economic hardship. The mutual aid societies and neighborhood cooperation that cushioned the Great Depression have been replaced by government programs that will be among the first casualties of fiscal crisis. Political institutions have been hollowed out by partisanship and corruption to the point where they're incapable of responding effectively to a major crisis. The bipartisan cooperation that enabled New Deal reforms seems impossible in today's polarized environment. Instead of pulling together to address problems, political leaders will likely spend their time assigning blame while the economy burns around them. The crash won't announce itself with dramatic headlines or obvious warning signals. It will begin quietly in the shadows of the financial system, with technical problems that most people never hear about. A pension fund will miss a payment here, a regional bank will freeze withdrawals there, a cryptocurrency exchange will go offline for maintenance. The financial media will dismiss these as isolated incidents, temporary glitches in an otherwise healthy system. But these aren't separate problems. They're symptoms of the same disease that killed prosperity in 1929. The belief that debt can create wealth, that speculation can replace production, and that financial engineering can overcome economic reality. The crash that's building today will make 1929 look like a gentle correction, because the bubble is bigger, the leverage is higher, and the interconnections are deeper than anything the world has ever seen. The most terrifying aspect is how confident everyone feels about their ability to see danger coming. In 1929, investors believed they were smarter than previous generations, that they had better information and more sophisticated tools. They trusted economists who assured them the Federal Reserve could prevent serious downturns. Today, we make exactly the same mistake, believing our computers and models and central bankers can protect us from forces that have destroyed wealth throughout human history. The setup is complete. The psychological conditions are identical to 1929. The financial imbalances are worse than anything in recorded history. The institutional safeguards have been systematically destroyed by the very people who were supposed to protect them. All that remains is the trigger, and that could come from anywhere at any time. A failed bank, a currency crisis, a geopolitical shock, or simply the recognition that the emperor has no clothes. When it hits, the destruction will be swift and merciless. Fortunes will vanish overnight, institutions will collapse without warning, and millions of people will discover that the security they thought they had was nothing more than a collective hallucination. The only question is whether you'll be prepared for what's coming, or whether you'll be another casualty of history's most predictable disaster. The crash is already here, it's just moving so slowly and in such complex ways that most people don't recognize it yet. But speed up the film, and you'll see the same pattern that played out in 1929. Speculation replacing investment, debt replacing savings, and confidence replacing reality. The ending is already written. The only variable is how many people will see it coming in time to protect themselves. The most dangerous part about what's unfolding isn't the crash itself, it's the timing. Every bubble follows the same psychological arc. Initial skepticism gives way to cautious optimism, then enthusiasm, then euphoria, and finally panic. We're currently in that euphoric phase where doubt has been banished and risk has been forgotten. This is the moment when ordinary people mortgage their futures for a chance at easy wealth, convinced that they're financial geniuses, rather than the latest victims of history's oldest con game. Look around you. Office workers are day trading from their desks, convinced they've discovered secrets that professional investors missed. Suburban moms are flipping houses with money borrowed against their retirement accounts. college students are taking out additional loans to buy cryptocurrency, treating speculation like a guaranteed path to wealth. The same fever that gripped America in 1928 has returned, but this time it's supercharged by technology and social media that turn financial markets into entertainment. The media plays the same role today that newspapers played in the 1920s, cheerleading every market advance and dismissing every warning as outdated pessimism. Financial television has become a carnival of prediction and promotion, where former traders turned entertainers promise viewers they can beat the market by following simple strategies. The internet has democratized bad advice, allowing anyone with a camera and confidence to become a financial guru, spreading the same dangerous myths that destroyed fortunes in 1929. But underneath reality remains unchanged. When the digital noise, the mathematical too many people are buying assets with borrowed money, prices become disconnected from any rational measure of value. Companies trade at multiples of revenue that would have seemed insane even at the peak of the dot-com bubble. Real estate prices in major cities have reached levels where median income families would need to dedicate their entire salary to housing costs. Cryptocurrency markets swing wildly based on social media posts, treating speculation like a sporting event rather than investment. The Federal Reserve has created moral hazard on a scale that dwarfs anything from the 1920s. By repeatedly bailing out failed speculation over the past 15 years, they've taught investors that risk has been eliminated from the financial system. This has encouraged increasingly reckless behavior, with pension funds and insurance companies piling into private equity, hedge funds, and other alternative investments that promise higher returns by taking hidden risks. When these investments blow up, the damage won't be confined to wealthy speculators. It will wipe out the retirement savings of teachers, policemen, and firefighters across the country. Corporate America has become addicted to financial manipulation rather than productive growth. Instead of investing in research, development, or expansion, companies use their cash flow and borrowed money to buy back their own stock, artificially inflating share prices and executive compensation. This creates the illusion of prosperity while hollowing out the real economy. When the bubble bursts, these companies will have no reserves to weather the storm because they spent everything propping up their stock prices during the good times. The commercial real estate sector provides a perfect example of how the current bubble differs from 1929 while following the same destructive pattern. Office buildings across America sit half empty as remote work has permanently changed business operations, but their owners continue to pretend these properties are worth pre-pandemic prices. Banks have extended and pretended on loans that should have been written off years ago, kicking the can down the road while the underlying problems get worse. Shopping centres and retail spaces that once anchored suburban communities now stand as monuments to an economy that no longer exists. These properties were financed with the same kind of complex securities that triggered the 2008 crisis, but the current bubble is larger and the underlying assets are worth even less. When reality finally forces a repricing of commercial real estate, the losses will cascade through pension funds, insurance companies, and regional banks that bought pieces of the toxic debt. The financial media will act surprised, just as they did in 2008, but the warning signs have been visible for years to anyone willing to look. International factors make today's bubble more dangerous than anything 1929 could have imagined. The dollar's role as the global reserve currency has allowed America to export inflation to the rest of the world, but this privilege comes with dangerous obligations. Foreign central banks and sovereign wealth funds hold trillions of dollars in treasury bonds, creating a dependency that could unravel catastrophically if confidence in American institutions wavers. China alone holds enough US debt to trigger a currency crisis simply by changing its buying patterns. Global supply chains that seemed efficient during calm periods have proven fragile when disrupted, creating shortages and price spikes that compound economic instability. The just-in-time manufacturing that maximized profits during good times has left businesses vulnerable to any interruption in the flow of goods and materials. When the financial crisis hits, these supply chain weaknesses will amplify the economic damage, turning what might have been a manageable recession into a prolonged depression. The derivatives market represents the most dangerous evolution from 1929 that almost nobody understands. In the 1920s, speculation was relatively straightforward. People borrowed money to buy stocks, hoping prices would rise. Today, the leverage is hidden inside financial instruments so complex that even the people trading them don't fully understand the risks. Credit default swaps, interest rate derivatives, and currency hedges have created a web of interconnected bets that spans the entire global financial system. The total notional value of these instruments exceeds $600 trillion, more than 7 times the size of the world economy. But notional value understates the danger because these derivatives are interconnected in ways that create systemic risk. When one major institution fails to meet its obligations, the cascade of defaults will spread through the entire system faster than regulators can respond. The collapse of Lehman Brothers in 2008 gave us a preview of this dynamic, but today's derivative exposures are orders of magnitude larger. High-frequency trading has turned financial markets into a casino where algorithms compete to exploit microsecond advantages in information flow. These systems create an illusion of liquidity during normal times, but they can amplify crashes by withdrawing from markets just when liquidity is most needed. The flash crashes that have become routine occurrences are warnings of what will happen when real selling pressure meets algorithmic trading systems programmed to cut losses instantly. Social media has replaced the stock tips and newspaper speculation that drove the 1929 bubble, but the psychological dynamics are identical. Instead of gathering around ticker tape machines, people stare at trading apps designed with the same psychological tricks used in casinos. Reddit forums and YouTube channels have replaced investment advisors, spreading the same get-rich-quick fantasies that destroyed fortunes in the 1920s. The democratization of financial information has also democratized financial delusion. The cryptocurrency boom perfectly captures the speculative mania that preceded 1929, but with digital assets that have no underlying value whatsoever. People mortgage their homes to buy Bitcoin, convinced they're early adopters of revolutionary technology rather than late arrivals to a speculative frenzy. The same language used to promote radio stocks in the 1920s is recycled to sell blockchain investments today. Revolutionary technology, unlimited potential, paradigm shift, new economy. The words change, but the con remains the same. Central banks around the world have synchronized their money printing in ways that make the 1920s credit expansion look conservative. The European Central Bank, Bank of Japan, and Federal Reserve have all pursued policies of quantitative easing and negative interest rates, flooding global markets with artificial liquidity. This coordinated intervention has created asset bubbles in every major economy simultaneously, ensuring that when one market crashes, the contagion will spread instantly across borders. The political response to the coming crash will likely make the economic damage worse rather than better. During the 1930s, America still had political institutions capable of bipartisan cooperation and long-term thinking. The New Deal programs that helped stabilize the economy required a level of social trust and governmental competence that seems impossible to imagine today. Instead of addressing root causes, contemporary politicians will likely respond with more of the same policies that created the crisis. Money printing, bailouts, and deficit spending that will set up even larger bubbles in the future. Demographic trends add another layer of danger that didn't exist in 1929. The baby boom generation is retiring en masse, forcing pension funds and retirement accounts to sell assets to meet benefit obligations. This demographic shift creates a structural headwind for asset prices, just as valuations have reached historic extremes. Younger generations, burdened with student debt and facing stagnant wages, don't have the resources to buy the assets that retirees need to sell. The mathematical impossibility of this situation guarantees falling prices, regardless of what central banks or politicians do. The housing market bubble has reached proportions that make the 2006 peak look conservative. Buyers are waiving inspections, bidding sight unseen, and stretching their finances beyond any reasonable limit to get into properties they can't afford. Investment companies are buying entire neighborhoods with borrowed money, treating homes like stock certificates rather than shelter. The same speculative fever that drove stock prices to unsustainable levels in 1929 has migrated to real estate, but with even more devastating potential consequences, because housing represents the primary store of wealth for most American families. When this bubble bursts, the foreclosure crisis will be worse than 2008 because the speculation has infected higher income brackets rather than just subprime borrowers. Doctors, lawyers, and tech workers who thought they were making safe investments will discover they've become speculators in an asset class that can fall just as fast as it rose. The social and political consequences will be severe because these are people who followed conventional wisdom and trusted the experts who assured them that real estate was a safe store of value. Student debt represents another parallel to the margin buying that fueled 1929, but with a cruel twist that makes it even more dangerous. Unlike stock purchases, student loans cannot be discharged in bankruptcy, creating a generation of debtors who will spend their entire working lives paying for degrees that don't provide the economic opportunities they were promised. This debt overhang will suppress consumer spending for decades, creating a deflationary spiral that makes economic recovery nearly impossible. The healthcare system has become financialized in ways that turn medical care into speculation rather than service. Private equity firms have bought hospital chains, nursing homes, and physician practices, loading them with debt and extracting profits while cutting costs and reducing quality. When the financial crisis hits, these leveraged healthcare companies will collapse, leaving communities without essential medical services just when they're most needed. Corporate pension plans that once provided guaranteed retirement income have been replaced by 401k accounts that shift all investment risk to individual workers. These accounts are loaded with stock and bond funds that will collapse simultaneously when the bubble bursts, wiping out the retirement savings of millions of people who trusted financial advisors and followed conventional wisdom about diversification. The idea that you can reduce risk by spreading it across different asset classes becomes meaningless when all asset classes are inflated by the same monetary policies. Insurance companies, which are supposed to provide stability and security, have become speculators in search of higher yields to meet their obligations. They've moved beyond traditional bonds into private equity, real estate, and other alternative investments that promise better returns by taking hidden risks. When these investments fail, the insurance system will collapse, leaving policyholders without the protection they paid for and relied upon. Municipal governments have joined the speculation party, investing taxpayer money in complex derivatives and structured products they don't understand. Cities and counties that should be focused on providing basic services have become hedge fund operators, chasing yield in markets designed to separate fools from their money. When these investments blow up, essential public services will be cut just when unemployment and social distress are rising. The velocity of modern communication means that when confidence breaks, it will spread at digital speed rather than the telegraph pace of 1929. Social media can turn isolated bank runs into systemic panics within hours, overwhelming the traditional circuit breakers and cooling off periods that regulators rely upon to maintain stability. The same technology that democratized speculation will also democratize panic, creating feedback loops that amplify crashes beyond anything history has recorded. But perhaps the most dangerous parallel to 1929 is the absolute confidence that most people feel about the safety of their investments and the competence of their institutions. Americans in 1928 believed they had discovered the secret to permanent prosperity through scientific management and financial innovation. Today's investors believe they're protected by deposit insurance, portfolio diversification, and central bank intervention. Both generations trusted experts who assured them that old economic laws no longer applied and that new tools had eliminated the risk of serious financial loss. The crash that's coming will be worse than 1929 because the speculation is broader, the leverage is higher, and the interconnections are deeper. When it hits, the destruction will be swift and merciless, wiping out wealth that took generations to accumulate and destroying institutions that seem too big to fail. The only question is whether you'll recognize the warning signs in time to protect yourself, or whether you'll become another casualty of history's most predictable disaster. The mathematical impossibility of the current situation means that collapse isn't a possibility, it's a certainty. The only variables are timing and magnitude. Every day the bubble continues to grow makes the eventual crash worse, but also provides more time for those wise enough to see what's coming to position themselves correctly. History shows that great fortunes are made during crashes by those who prepare while others celebrate, who save while others spend, and who remain skeptical while others succumb to euphoria. The parallels to 1929 are so exact that they read like a script written by economic destiny itself. But this time the stakes are higher, the weapons more powerful, and the fallout more global than anything the world has experienced. The crash that destroyed prosperity in 1929 led to reforms and regulations that prevented similar disasters for decades. Today's crash will likely be followed by even more dangerous policies as politicians and central bankers do more of what caused the crisis in the first place. The endgame isn't just financial collapse. It's the complete restructuring of American society around the wreckage of failed institutions and broken promises. When the dust settles from this crash, the middle class as we know it will have vanished, replaced by a stark division between those who owned real assets before the collapse and those who trusted paper promises from institutions that no longer exist. Look at what happened after 1929, but imagine it happening to a society that's already fractured by political polarization, social media echo chambers, and the breakdown of traditional community bonds. The breadlines and Hoovervilles of the 1930s will be replaced by tent cities and digital riots, as people who thought they were financially secure discover that their wealth existed only in computer databases that can be wiped clean with a few keystrokes. The psychological trauma will be worse than the Great Depression because today's Americans have been conditioned to expect constant growth, perpetual prosperity, and instant gratification. Previous generations understood hardship and had experience with economic cycles, but we've created a society that treats any decline in living standards as a moral emergency, requiring immediate government intervention. When that intervention fails, as it inevitably will when the government itself is bankrupt, the social fabric will tear in ways that make the 1930s look orderly by comparison. Educational institutions have become pyramid schemes that sell debt-financed credentials for jobs that don't exist at salaries that can't support the loan payments. Universities have built massive administrative bureaucracies and luxury facilities funded by student borrowing, creating the same kind of malinvestment that characterized the real estate bubble of the 2000s. When students stop borrowing because they realize the degrees are worthless, the entire higher education system will collapse overnight, leaving campuses as empty as the shopping malls that once seized American prosperity. Healthcare symbol costs have been inflated by the same easy money policies that created bubbles in housing and education. Hospitals have been bought by private equity firms that load them with debt while cutting staff and services, extracting profits while degrading care. Insurance companies have become speculation vehicles rather than risk management tools, investing premiums in the same bubble assets that will collapse when reality reasserts itself. When the financial system fails, medical care will become a luxury good, available only to those who can pay cash, returning America to a pre-industrial model of healthcare delivery. The retirement crisis that's already unfolding will accelerate into a humanitarian disaster when pension funds and 401k accounts lose half their value in a matter of weeks. Millions of Americans who plan to retire in comfort will find themselves working until they die, competing with younger workers for jobs that pay subsistence wages. The social contract that promised security in exchange for a lifetime of work and saving will be revealed as a fraud perpetrated by financial institutions that privatize profits while socializing losses. Infrastructure that was built during more prosperous eras is already crumbling from decades of deferred maintenance and political dysfunction. When tax revenues collapse, along with the economy, roads, bridges, water systems, and power grids will deteriorate rapidly, creating third world conditions in regions that once represented the pinnacle of modern civilization. The interstate highway system that enabled American prosperity will become a monument to a more competent age as communities become isolated by their inability to maintain connections to the broader economy. Technology companies that seemed invincible during the bubble will be revealed as overvalued speculation vehicles with business models based on advertising revenue that evaporates during recessions. The digital platforms that currently dominate communication and commerce will struggle to survive when businesses stop paying for ads and users stop buying products online. The internet itself may fragment into regional networks as the economic model that supported global connectivity breaks down along with everything else. Energy markets have been distorted by the same speculation and debt financing that infected every other sector of the economy. Fracking companies borrowed billions to extract oil and gas that they sell at prices below the cost of production, hoping to achieve profitability through scale and efficiency gains that never materialized. When credit markets freeze, these companies will shut down production, creating energy shortages that compound the economic crisis with physical hardship reminiscent of the 1970s oil shocks. Agricultural systems that feed America have become dependent on complex supply chains, chemical inputs, and financial instruments that will be disrupted by economic collapse. Corporate farms that seemed efficient during stable times will struggle to operate when credit disappears and input costs spike. Small farmers who might provide resilience have been driven out of business by industrial agriculture, leaving food production concentrated in the hands of leveraged corporations that will fail when their financing dries up. The dollar's role as the global reserve currency, which allowed America to export inflation and import goods at artificially low prices, will end when foreign creditors lose confidence in American institutions. This will force a rapid adjustment in living standards as imports become prohibitively expensive and domestic inadequate to production capacity proves. Americans replace them will discover that they've been living beyond their means for decades, subsidized by foreigners who will demand payment in assets rather than promises. Regional banks that seem stable will collapse when commercial real estate loans go bad and depositors lose confidence in institutions they've never heard of. The bank runs will happen at digital speed as people transfer money with smartphone apps faster than regulators can respond. Federal deposit insurance, which was designed to handle simultaneous collapses across isolated bank failures, will be overwhelmed by the entire system, leaving depositors with worthless government guarantees backed by a treasury that's already insolvent. State and local governments that relied on property taxes and sales taxes will see their revenues collapse just as demand for social services explodes. Cities that seemed prosperous will declare bankruptcy, cutting police, fire, and emergency services while raising taxes on the shrinking population that can't afford to leave. The municipal bond market, which has been a supposedly safe haven for conservative investors, will implode as cities default on obligations they can no longer meet. The legal system that enforces contracts and protects property rights will be overwhelmed by the sheer volume of foreclosures, bankruptcies, and disputes arising from financial collapse. Courts that already struggle with their caseloads will face an avalanche of litigation from investors who discover that their assets were pledged as collateral for multiple loans, creating conflicting claims that can't be resolved through existing legal frameworks. The rule of law itself will become a casualty of economic chaos. Criminal justice systems will face budget cuts just as crime rates spike due to unemployment and social disruption. Police departments will be forced to prioritize the most serious offences while property crimes go uninvestigated. Private security will become a luxury good, creating gated communities for the wealthy while everyone else faces rising lawlessness. The social order that seemed permanent will reveal itself as dependent on economic prosperity that no longer exists. Transportation networks that seemed efficient will break down as airlines, trucking companies, and shipping firms face bankruptcy from the combination of high fuel costs and reduced demand. Supply chains that span continents will revert to regional networks, forcing communities to become more self-sufficient while losing access to goods they've taken for granted. The just-in-time delivery systems that maximized efficiency during stable times will prove catastrophically vulnerable to disruption. Media companies that depend on advertising revenue will face extinction as businesses cut marketing budgets and consumers reduce spending on entertainment and information. The news organizations that might provide crucial information during a crisis will be among the first casualties of economic collapse, leaving communities isolated and misinformed just when accurate information becomes most critical. Social media platforms will struggle to moderate content and maintain service as their revenue models collapse along with the broader economy. Professional services that seemed recession-proof will discover that their clients can no longer afford legal advice, accounting services, or consulting fees when businesses are fighting for survival. Law firms, accounting practices, and consulting companies will downsize rapidly, adding their highly educated employees to unemployment lines alongside factory workers and retail clerks. The service economy that replaced manufacturing will prove even more vulnerable to economic shocks. Cultural institutions that define American civilization, museums, libraries, theaters, orchestras, will lose their funding from both government and private sources, creating an intellectual dark age as communities focus on basic survival rather than higher pursuits. Universities that aren't directly supported by student loans will close their doors, ending research programs and dispersing faculties that took generations to assemble. The cultural capital that makes civilization possible will be squandered in a desperate attempt to maintain current consumption levels. Religious institutions that might provide social cohesion during hard times will struggle as their congregations lose the ability to provide financial support. Churches, synagogues, and mosques that serve as community centers will close their doors, eliminating social networks that could help people weather economic storms. The spiritual resources that sustained previous generations through hardship will be unavailable to a society that abandoned traditional beliefs in favor of material prosperity. Charitable organizations that address social problems will see their donations evaporate just as need explodes, creating a humanitarian crisis that overwhelms government resources. Food banks, homeless shelters, and social service agencies will be forced to turn away clients while closing their own operations due to lack of funding. The safety net that seemed adequate during prosperous times will prove woefully inadequate when tested by mass unemployment and social disruption. International alliances that seemed permanent will fracture as nations focus on domestic problems rather than global cooperation. Trade agreements will be abandoned, military alliances questioned, and diplomatic relationships strained by the economic nationalism that always emerges during financial crises. The global order that has maintained relative peace and prosperity will be replaced by competition for scarce resources and mutual recrimination over who caused the collapse. Military spending that seemed untouchable will face cuts as governments struggle with budget deficits and domestic unrest. Defense contractors that appeared financially solid will face bankruptcy as weapons programs are cancelled and maintenance contracts terminated. The military-industrial complex that drove technological innovation will shrink rapidly, eliminating research and development programs that might have provided solutions to long-term problems. Scientific research that depends on government and corporate funding will largely cease as resources are redirected to immediate survival needs. Universities will eliminate research programs, corporations will close their laboratories, and government agencies will cut their science budgets. The technological progress that seemed inevitable will slow or reverse as society loses the luxury of investing in long-term projects with uncertain payoffs. Environmental protection efforts that seem to be gaining momentum will be abandoned as communities focus on basic economic survival rather than long-term sustainability. Clean energy projects will be cancelled, conservation programs eliminated, and environmental regulations relaxed in desperate attempts to restart economic growth. The climate crisis that seemed manageable with sufficient investment will accelerate as short-term thinking dominates policy decisions. Space exploration programs that captured public imagination will be terminated as governments redirect spending to social problems on Earth. The International Space Station will be abandoned, Mars missions cancelled, and satellite programs reduced to essential military and communication functions. Humanity's expansion into space will be delayed by decades or centuries as civilization turns inward to address terrestrial crises. The internet infrastructure that seems permanent will degrade as telecommunications companies struggle with reduced revenue and increased maintenance costs. Broadband networks will become less reliable, data centers will close, and cloud services will be disrupted by power outages and equipment failures. The digital economy that seemed to transcend physical limitations will prove dependent on the same fragile infrastructure as every other sector. Social media platforms that seemed too big to fail will face user exodus and advertiser abandonment, forcing them to dramatically reduce services or shut down entirely. The digital communities that replaced physical neighborhoods will dissolve, leaving people isolated and disconnected just when they most need social support. The network effects that made these platforms valuable will work in reverse during the collapse, accelerating their decline. Cryptocurrency markets that promised to provide an alternative to government money will collapse as investors realize that digital tokens have no intrinsic value and depend on the same electrical grid and internet infrastructure that will be disrupted by economic chaos. Bitcoin and other cryptocurrencies will be revealed as speculative bubbles rather than revolutionary technologies, leaving their believers with worthless digital wallets and empty promises. The gig economy that seemed to provide flexibility and opportunity will evaporate as consumers reduce discretionary spending and businesses eliminate non-essential services. Uber drivers, food delivery workers, and freelance contractors will find their income disappearing as demand collapses and platforms shut down operations. The independent contractors who thought they were entrepreneurs will discover they were actually the most vulnerable workers in the economy. Retail chains that survive the rise of online commerce will face the final blow as consumer spending collapses and commercial real estate becomes unaffordable. Shopping centres and strip malls will stand empty, creating urban blight that makes entire communities less attractive and valuable. The consumer economy that drove American prosperity will shrink to basic necessities, eliminating millions of jobs in sales, marketing, and related services. Tourism and hospitality industries that seemed recession-resistant will face total collapse as people eliminate travel and entertainment from their budgets. Hotels, restaurants, airlines, and cruise lines will declare bankruptcy en masse, eliminating millions of jobs and stranding assets that can't be repurposed for other uses. Cities that depended on tourist revenue will face budget crises that force them to cut basic services while raising taxes on remaining residents. The crash won't be a single event that happens and then ends. It will be a prolonged unwinding of financial and social relationships that took decades to build. Each institution that fails will create problems for other institutions, setting up cascading failures that continue for years. The complexity that seemed to make the system more efficient will instead make it more fragile as unexpected connections transmit shocks throughout the entire network. Recovery won't begin until the malinvestments are liquidated and resources are redirected to productive uses rather than speculation. This process, which economists call creative destruction, will be more painful than any recession in living memory because the distortions are so pervasive and the debt burdens so large. Communities that adapt quickly by developing local production and trade networks will fare better than those that wait for outside help that isn't coming. The America that emerges from this crash will be unrecognizable from the country we know today. It will be poorer in material terms but potentially richer in social capital as people rediscover the importance of family, community, and mutual aid. The individualism and consumerism that defined the bubble years will give way to cooperation and conservation as survival strategies. Whether this transformation leads to renewal or further decline depends on choices that haven't been made yet, The financial crash that's coming isn't just another recession that can be managed with the right policies. It's the end of an entire economic model based on debt, speculation, and the belief that consumption can exceed production indefinitely. The institutions, assumptions, and relationships that define modern American life will all be tested and found wanting. Those who understand what's happening and prepare accordingly will inherit the future. Those who continue to trust in systems that are already failing will become casualties of their own misplaced faith. The crash of 1929 happened because people forgot that wealth cannot be borrowed into existence, that speculation cannot replace production, and that confidence cannot overcome mathematics. Today we've made the exact same mistakes, on a scale that would have terrified even the most reckless speculators of the Jazz Age. The bubble that's about to burst will make Black Tuesday look like a gentle market correction, because this time the entire global economy is built on the same fraudulent foundation that collapsed in 1929. History doesn't repeat, but if you ignore its lessons, it will crush you all the same. The choice is yours. Prepare for what's coming, or become another casualty of humanity's oldest and most predictable disaster.